to look at some price earnings charts and some EV to EBITDA, so enterprise value, or market cap rather, plus debt compared to EBITDA, earnings before interest, taxes, depreciation, and amortization, essentially operating cash flow. So we're going to start here with J.P. Morgan and Bank of America. JC, what are we seeing?
Yeah, so I mean, sort of in line with the broader market, the banks have sold off, pretty significantly this year, and as a result of that, we're really starting to see some compelling opportunities and valuations emerge in the equity markets. If you look at the banks, J.P. Morgan and Bank of America, which we own for our clients, they've seen a really dramatic reversal from the really strong performance that they had back in 2020 and 2021 as we were coming out of the pandemic. At that time, they had really strong capital markets and investment banking performance. And as rates started to rise coming out of the pandemic, the lending component of the banks became increasingly profitable. And so we saw some really strong returns. But at this point in time, we're coming into an environment where growth is starting to slow. People are worried about a recession. And so we're starting to see some pretty attractive valuations showing through for the banks. If you look at the JP Morgan chart, that is a 10-year perspective of the 1-year forward and 2-year forward price to earnings ratio that JP Morgan has traded out over the last 10 years. And it's sitting at around 1 standard deviation cheaper than the average. And if you look at Bank of America is about 2 standard deviations cheaper than where it usually trades. So these are really attractive valuations, we think, and it's not something that happens all the time. So it's something that we've taken advantage of. And I think it's important to remember that these are really great businesses. They've come a long way from the great financial crisis. They've really de-risked their balance sheet. They're managing their liabilities a lot more prudently. So we don't think that a recession this time around is going to pose the same sorts of risk for the banks or for the global economy as a whole as it did back in 2008, 2009. And if you just look at a relative value comparison, Bank of America has a dividend yield of about 2.66%. JP Morgan has a yield of about 3.53%. And if you compare that to a 10-year treasury yield in the States, for example, which is about 2.75%, these are really, sort of compelling just from an income perspective. And on top of that, if you purchase the stock, you're exposed to the potential for capital appreciation, picking it up at a discount here. It's I think, very attractive in comparison to fixed income, like a 10-year. If we move forward to Home Depot,
JC, can I just interrupt for a second? Another way to think about it, back in 1985 or 6, when I got involved in the business, we had just gone through the lesser developed country crisis, and bank stocks around the world had almost gone broke, and CIBC was yielding 8% dividend yield, and people worried, the banks had almost all gone broke. And I made my living going around knocking on doors, telling people, if you put your money in the bank, lend your money to the bank and deposit her, right now you're being paid about 1%. But if you own the bank, you're being paid 3.5% with all the upside. So it just seems to me that investors are anticipating really bad news. They're lending money to the bank at incredibly low rates. The banks are lending it out at higher and higher rates. Their profits are exploding. And then when you listen to the CEO of JP Morgan or the CEO of Bank of America, they're saying they've never seen the consumer in better financial shape. They're not seeing any signs of credit delinquencies. They're not seeing any problems whatsoever. And they're well reserved. They're not conducting the same kind of business shenanigans they were doing back in 05, 06, 07, lending money that didn't have any income. So these banks are in good shape, and they're paying you a lot of money, and they're down 30. JP Morgan and Bank of America are down 34% in 5 months. So when things are on sale, you should be buying them, not selling them and worrying about it.
And disclosure, both those banks are in the Davis Rea Equity Fund, correct? JP Morgan, Bank of America?
100%.
Okay, JJ, right. The Home Depot, you're going to look at a chart for them and some other metrics.
Yeah, so I think this is a really interesting one. And that's because, like we talked about before, markets are forward-looking in nature. And so that means that prices tend to reflect expected future outcomes. And for all the talk that we hear about a recession, cooling housing market, it's really interesting to look at Home Depot's valuation on an EV to EBITDA basis, 1 year forward and 2 years forward. right now it's trading right in line with its 10-year average. And I think that we're seeing that for a few reasons. The first one is it's unlikely that the current housing market correction that we're seeing in North America is going to pan out to be as severe as it was in the Great Financial Crisis. A lot of the excesses that were present at that time have been mitigated. Lending standards are significantly tighter. And just because housing prices are falling, it doesn't prevent new homes from being built. It doesn't stop renovations from happening. And over the last 10 years, there's been a tremendous amount of underinvestment in the space, largely as a result of the financial crisis. And so there's definitely some room to run here from a new homes perspective. And it's this environment of underinvestment in the housing stock. That's why we think that demand for housing is likely to stay elevated because the supply just isn't where it needs to be. And despite the weakness that we're seeing right now in terms of prices and affordability, we're still seeing multifamily housing starts and permit applications in the U.S. stay really strong. And that's because home builders have recognized that there's a need for more affordable housing units. There's not enough of them. And that's a really positive indicator for companies like Home Depot. And I think lastly, I'll just add that Home Depot is a company that has a significant degree of pricing power. And that's really important in an environment where you have high inflation like we do now. When building material costs increase, prices increase at Home Depot. And so over the course of the pandemic and as inflation has ramped up, we've seen Home Depot has been able to maintain their margins and it's fared really well in this environment. So just to wrap it up, I think despite all the noise, there's still a lot of value here. And I think, just looking at this chart, the market is really pricing in that outlook.